Hey everyone, it's Bob with another FINOP Controller webcast. This is part one of a two-part presentation on using allocations to automate the reserve calc process. This week, we're going to discuss how to create a testing process when building an allocation program. Now, the customer reserve calculation is designed to protect customer funds, and they can be funds that you receive from the customer as a deposit, any proceeds from the sale of customer securities, if they've got customer dividends or stock reorganizations, or if you've taken cash from customers and the firm doesn't have the securities, similar to fails to receive or the firm's market making activities. In addition, if you're using the customer securities as collateral for bank and stock loans. And finally, any cash and securities that are in suspense accounts based on aging requirements. For this presentation, we have two learning objectives. The first one is to demonstrate how to perform a manual reserve calculation, and then we're going to explain which security transactions should be included in the reserve calc. Now, this is part one of a two-part webcast. In the second webcast, we're going to show how an allocation program can be used to estimate which security transactions are customer related. We're going to step through the process of creating an allocation program. And finally, we're going to explain how to adjust the sequence so you can approximate a manually performed reserve calc. A few notes before we get started. This presentation is for educational purposes only. If you're doing an actual reserve calculation, I'm going to refer you to the FINRA website at finra.org, where you can get their interpretations for financial and operational rules. And in addition, I think the best way to make use of this presentation is to review it versus your firm's calculation and compare the various items. A brief review of the categories for the reserve calculation. On the credit side, you have items 1 through 5, and they are related to customers' funds, either the funds that they've given to you or the funds that they've received by using customer securities as collateral for, say, stock loan or for bank loans. 6, 7, 8, 9, they are penalties or charges for efficiency for aged items, and there are some time frames that are related to each one of those items. Now, for this presentation, we're going to be manually doing a reserve calculation. So to make it a little bit easier to work with it, what we're going to do is only use the first 4 categories. On the debit side for the reserve formula, there is 10, which is debits in margin and cash accounts. That's money that we have lent to the customers to buy securities. For 11 and 12, that's securities borrowed and fails to deliver. And finally, 13 and 14 is cash received from customers and placed on deposit with either Options Clearing Corp or at other clearing agencies. For this presentation, we're only going to be using items 10, 11, and 12. When you're working to automate your reserve calculation by doing a securities allocation program, you want to create a model. And what you're going to do with that model is you're going to approximate the firm's business. And within that model, you're going to create transactions that are typical of the firm. And you're going to determine which customer-related transactions should be included in the reserve calculation. Once you've done that, you're going to perform a reserve calculation by hand based on what you've done in number 1. And this will be the baseline to compare the various models. Finally, and we'll be going over this in the second webcast, using Excel, you're going to build a securities allocation prototype, and you're going to organize the sequence until it approximates the results when you perform the calculation by hand from number 1 and number 2. For our model, we've created 8 transactions, and I want to point out that all the securities are going to be valued at $35 per share. So for the first transaction, it's actually made up of deposits from various different customers and other entities. Customer A, who is going to short securities, he's going to deposit $12,250. C is buying securities. D is also going to buy securities and buy on margin. We have a non-customer Z, he's buying securities. And the BD parent is going to contribute $2,000 to the BD itself. Second transaction is the firm is going to buy 200 shares for inventory. and they're going to put all the shares out for loan. Customer A is going to short 700 shares, and the firm is going to borrow shares to make delivery. For 4, the customer B is going to sell 500 shares through the BD to another dealer, and the shares are not held at the broker-dealer, so that means the broker-dealer is waiting for customer B to deliver the shares to it. Customer B is going to fail to deliver on settlement date. Customer C is going to buy 250 shares. The contra firm doesn't deliver, and therefore we're going to debit customer C's account on settlement date, and a fail to receive is going to be established. Non-customer Z is going to buy 38 shares. Same situation, contra firm's not going to deliver, and so her account is going to be debited and a fail to receive is going to be established. Customer D is going to buy 800 shares on margin, and 400 shares is going to be financed by stock loan. Customer E is simply going to transfer in 50 shares from another broker-dealer to E's account at the BD. Based on the transactions, we've created the daily blotter with the entries to the cash journal and to the stock record. You can see up here, these are all the deposits, and this is what it looks like on the cash journal. Notice there's no entries on the stock record. For comparison, look down transaction 8 where customer E, he owns 50 shares and he transferred them in from another broker-dealer. You can see here nothing on the cash journal. Only item recorded was on the stock record. The second transaction was the firm buying 200 shares for inventory. You can see that there's $7,000 showing as an asset on the cash journal. And also the stock record has the 200 shares long. Going down, you can see here for customer 3, he shorted 700 shares and the firm had to borrow the shares to make delivery. So you end up with a stock borrow for $24,500 and the customer payable because it's a short sale, so therefore he's going to get the cash from the sale for $24,500. And on the stock record, you can see we've recorded the stock borrow, 700 shares, and the customer short for 700 shares. Let's take a moment here and notice that cash and securities move together. The inventory was $7,000 and that was a debit on the balance sheet. And it was on the long side of the stock record for firm long. Number 4, customer B, he sold 500 shares. And you can see we have credited him for $17,500. And at the same time, because he hasn't made a delivery, he's going to be short 500 shares. And again, it's moved to the same side. In this instance, it's on the right side. That's one way you can determine whether the stock record and the cash journal are correct because the entries will move in the same direction. Using the transactions from the daily blotter, we have sorted them depending upon their impact on the reserve calc. Items in green will be included in the reserve calc. The yellow item that will be subtracted from the reserve calc. And finally, the items down at the bottom, 2, 7, and 8, the blue items, they will have no impact on the reserve calc. Say, for example, the firm long versus the firm bank loan. Firm items aren't included in the reserve calculation. Customer long versus box, customer D and customer E, both of these are fully paid for securities. Therefore, there's going to be no impact because we have their shares ready for delivery if needed. Using the trial balance and the customer transactions, we're able to do a reserve calc by hand. And you can see over here with the customer payable for $54,250, that's traced directly from the trial balance for the same dollar amount. Stock loan, $14,000, and here it is on the trial balance again. Now the failure receives for the reserve calc by hand is $87.50, and you can see here on the trial balance it's $10,080. The difference being is the $1330 for the non-customer Z fail to receive. Same situation on the debit side, customer receivables, $14,000. You can trace it here to the trial balance again. Stock borrow for $24,500 up here, and the fail to deliver for $17,500. Credits less debits is $21,000, and we're going to have an additional charge of 3% of the debits. Now, normally the way that's recorded is you would subtract off 3% from the debits and then subtract that amount from the credits. We've done it this way to make it just a little bit easier to demonstrate the transactions and how we're going to produce a automated reserve calc that it's just easier to follow. One thing to take away from this presentation is that with a small number of customers/transactions and a limited number of securities, you can manually calculate the reserve deposit. And I'm going to tell you this is a good skill to have, especially when you're troubleshooting the reserve. However, as the number of transactions increase, the firm needs an automated process to identify the customer-related securities transactions and separate them from the non-customer and proprietary transactions. Now, the SEC will allow firms to identify customer-related security transactions by using an allocation program, and that's going to be the subject of Part 2. If you have any questions on today's webcast, please send me an email at bob@rmmilburnconsulting.com or through LinkedIn at Robert Milburn CPA. Thanks for your time today.